Welcome to this week's market update, where we review the key developments that shape markets, highlight what drove our recent performance, and look ahead to important events on the horizon. Let's start with what moved markets this past week. The big story was American consumers, who continue to defy predictions of a slowdown with surprisingly strong spending data. July retail sales rose a healthy 0.5%, led by strong car purchases and robust online shopping. This tells us consumers are still confident enough to make big-ticket purchases while embracing the convenience of e-commerce. What's interesting is that while some individual retailers are struggling, like Pandora, this seems to be more about competition between companies rather than consumers pulling back overall. For our portfolios, this reinforces why we focus on high-quality companies with strong brands and competitive advantages. When consumers keep spending but become more selective, the winners are businesses that offer the best value and experience. The bond market showed remarkable stability this week, with the 10-year Treasury yield holding steady around 4.29%, despite higher than expected inflation data. This calm reaction is quite different from earlier this year, when every data point caused wild swings. It suggests bond investors are looking at the bigger picture, confident the Federal Reserve can manage the economy without dramatic shifts. This creates an attractive environment for fixed income. Yields remain appealing, while there's potential for price gains if the economy moderates. It's why we maintain meaningful bond allocations, even during uncertain times. Stock markets also had an impressive week, with S&P 500 futures rising after the strong retail data. What's encouraging is how investors are interpreting the news. The economy is strong enough to support corporate profits, but not so hot that it forces the Fed to raise rates. This Goldilocks scenario is building confidence that companies can grow earnings, while valuations also improve. We're seeing opportunities from established tech leaders to consumer companies capitalizing on household spending. This environment rewards our approach of owning quality businesses that can thrive through both earnings growth and multiple expansion. Now let's look at what drove our performance over the past week and why we remain confident in our positioning. Tesla was our top performer with a 5.9% gain after announcing a major strategic shift. Instead of trying to build all of its AI technology in-house, Tesla is partnering with Samsung and investing $16.5 billion to co-develop advanced chips. This is smart business. By working with established chip makers, Tesla can accelerate its self-driving and robotics programs while spending less capital. The market loved this more efficient approach, recognizing Tesla is focusing on what it does best while partnering for specialized components. It shows why we own Tesla. They're willing to adapt their strategy to achieve ambitious goals more effectively. The information technology sector led our performance, with nearly all tech holdings posting solid gains. Apple rose over 6%, while semiconductor companies like Nvidia, Qualcomm, and Broadcom also contributed strong returns. Several powerful trends are converging here. Businesses racing to implement AI, governments incentivizing domestic chip production, and established leaders benefiting from stable trade policies. Our tech companies have the scale and resources to navigate policy changes while continuing to innovate. Despite higher valuations, the growth potential justifies our allocation. These aren't speculative bets, but investments in cash-generating companies with technological advantages. Our size strategy was this week's strongest performer, with large-cap holdings significantly outpacing smaller companies. Giants like Apple, Tesla, Amazon, and Alphabet all delivered impressive gains. During uncertain times, investors naturally gravitate towards larger companies, and for good reason. These businesses have financial strength to weather storms, global reach to capture opportunities, and resources for next-generation technologies. They can navigate complex regulations and adapt to policy changes better than smaller competitors. Our Canadian holding Royal Bank also contributed, showing this isn't just a US tech story, but broader recognition for large-cap leadership. Looking ahead, here are the key events we're monitoring that could shape markets in the coming week. Tuesday brings housing market data, showing how builders are responding to higher mortgage rates and economic uncertainty. June's numbers revealed interesting trends. Overall, construction starts rose nearly 10%, but entirely from a 30% jump in apartments and condos, while single-family homes declined for the third straight month. This matters because housing drives so much economic activity. When builders are confident, it signals optimism about jobs and consumer demand. For investors, housing trends provide early signals about economic health. Thursday morning's jobless claims continue to be our most timely employment indicator. Recent data has been encouraging. New claims dropped to 224,000, while continuing claims fell to 1.95 million. We'll watch for any signs businesses are reducing staff due to higher costs or slowing demand. With unemployment steady at 4.2%, weekly claims help us spot trends before monthly reports. Strong employment supports consumer spending and corporate profits. The week's biggest event is the Federal Reserve's Jackson Hole Symposium, running Wednesday through Friday. This gathering brings together central bankers from 70 countries to discuss labor markets and economic policy. Fed Chair Powell's Friday speech will be closely watched for hints about September's policy meeting and the path for interest rates. While it sounds technical, past Jackson Hole speeches have moved markets significantly as investors adjust rate expectations. Powell's comments could influence both stocks and bonds, particularly regarding the timing and pace of potential cuts. As always, we remain focused on what matters most, helping you achieve your long-term financial goals through disciplined investing and thoughtful portfolio management. Thanks for joining us, and we'll see you here next week.